Okay. Good morning, students. Welcome back to the session on Ind AS. So today we'll continue the discussion on consolidation financial statements. In the last sessions, we have covered about the assessment of control. That means we have covered all about getting into a situation wherein investment in an investee happens to be a subsidiary. Okay, or through the investment in an investee, investor used to get control. Correct? Yeah. We were discussing about investment entities when we last, ended our session. And in respect of investment entities, once again, the basic purpose or the basic idea was to understand the exemption requirements from preparing the consolidated financial statements. So today, we'll continue our discussion in respect of investment entities. For the investment entities, we understand that three criteria are mandatory. You remember? Yeah. For the investment entities, three criteria are mandatory. So if the investment entities fulfill all those three criteria, only then they become investment entities, otherwise not. And in respect of those three criteria, we discussed that the business purpose is very important criteria. Yeah. Anyways, all the criteria are important, but this is something which is very important. So we'll now continue with our discussion in relation to the business purpose of the investment entity. Okay. Yeah. So I would suggest if you can go to page number 41 of the study material, unit number 3. If you can go to page number 41 of the study material, unit number 3. Okay, yeah. Definition of an investment entity requires purpose of investment entity to be investing solely for capital appreciation or investment income, or it can be both. It cannot be anything other than this. Capital appreciation, we discussed that this could be in the form of making an investment in certain instruments and the market valuation of which, let's suppose, it goes up. So that is how we earn from those investments. Investment income is what? Investment income could be in the form of dividends, rental income, or interest. Because if you invest in any securities, if you invest in any sort of instrument, what is it that you will get from them? Dividend, interest. So it could be in various forms through which you can earn from that. Yeah. Now there are certain documents or other evidence that indicate entity's investment objective. Now in this case of an investment entity, it is very important for us to assess what's the objective for which this entity has been established, means the business purpose of this entity. And how do we get to know about the business purpose? One, through the business activities, which you can see. Yeah, that means by going through the books of accounts of the entity. But there are certain documents which will also help us to understand about the business purpose of this entity. And what are those documents? Offering memorandum of the entity. Publications distributed by the entity, if there are any publications which this entity distributes. Partnership documents of the entity. So in case this happens to be a partnership organization wherein partners are involved. Yeah. Manner in which entity presents itself to the other parties. And what are those other parties? Potential investors or the potential investees. Okay. Yeah. Let's look at one example now. An entity may present its business as providing medium-term investment for capital appreciation. In contrast, an entity that presents itself as an investor whose objective is to jointly develop, produce, or market products with its investees has a business purpose that is inconsistent with the business purpose of an investment entity. Because the entity will earn returns from development, production, or marketing activity as well as from its investments. Yeah. Now, as we discussed, that such an entity means an investment entity should not be earning or should not be providing any sort of return other than these two. So it's not that if an entity is providing returns in the form of capital appreciation, or let's suppose investment income, or let's suppose there is some more income or some more return which it provides to the investors, then it will be helpful. No, it cannot be more than these two. It has to be only either one of these things or both these things. Nothing beyond that. Okay, yeah. An investment entity may provide investment related services. What are those investment related services? Investment advisory services, investment management, investment support, and the administrative services around it to third parties as well as to its investors, even if those activities are substantial to the entity, subject to the entity continuing to meet the definition of investment entity. And why are these relevant? Let's try to understand. Let's suppose if an investment entity provides services related to investment to its investors. So in that case, even if it's providing the services, is the investor getting any return other than capital appreciation or investment income? No. Ultimate objective, even in that case, happens to be getting the return, which is either of these two from the investment entity, or if you look at it from the perspective of investment entity, it has to be return which is limited to these two to be provided to the investor. Yeah. In fact, that is also a condition. So we cannot breach that condition in any case. Okay. Now what we can do is we can look at illustration number 20. Let's look at illustration number 20. And through this, we'll try to understand about an entity, in which case that entity can be considered to be an investment entity. So this is page number 14.47. So this page number was different. And this is illustration number 20. Yeah. An asset manager has set up an investment fund for the purpose of acquiring capital contributions from various investors by issuing them units in the fund and investing those contributions in the equity share capital of various entities for the purposes of earning capital appreciation on those investments. Following is the structure of the fund. There are various investors, then there is investment fund. And this fund invested in equity shares of various entities. Okay. Now, apart from investments in various entities, investment fund also provides its investee some strategic advisory services so that it can result in increase in capital appreciation from investment in those investees. It also provides its investees financial support in the form of loan to provide them with funds for acquiring capital assets. The investment fund does not hold such investments for a period longer than 5 years. So that's the maximum period. Investment fund measures and evaluates the performance of its investments on fair value basis. You need to comment with reason whether this investment fund will be an investment entity or not. Yeah, so all of you need to answer this. I think this is fairly simple and with reason, please. So I'm just waiting for a response. Tell me whether this investment fund will become an investment entity or not. Quickly. I'm waiting for the response. Yes, all of you, tell me. Let me just look at the responses now. Okay, yeah, so I think you're still analyzing it and I'm waiting for a response. Seems you're still analyzing it. Quickly, I think this is a fairly simple one and you can answer this very easily. Just try to go through those conditions for an entity to become an investment entity. So will this fund meet all those three criteria or not? On the basis of those three criteria, you can just answer this. Yes. Any responses? Or should we go to the solution then? Okay, so let's go to the solution. See, there are three criteria for an investment entity. What are those? First, it should have multiple investors and its business purpose should be that provides return in the form of capital appreciation or investment income or both. And third, it measures its investments on a fair value basis. Now, out of these elements, investment fund fulfills two elements very clearly. That is, obtains funds from more than one investor for providing investment management services and measures and evaluates its investments on fair value basis. Yeah, from the structure itself, it's very, very clear. The typical characteristics of an investment entity are also present in the structure of investment fund. That is, more than one investment, more than one investor. Investors are all unrelated, and investment fund issues units in the fund to the investors. With respect to the business objective, the objective is to earn capital appreciation from its investments. The strategic advisory services, financial support provided to the investees are extended with the intention of earning higher capital appreciation from the investees. However, judgment should be applied that these do not represent substantial business activity or a separate substantial source of income for the investment fund. If the investment fund concludes that these services and financial support to investees are not substantial, okay, these are not substantial, and substantial source of income for the investment fund is what? Is capital appreciation only, or say investment income only, or say only these two, means capital appreciation and investment income. In such a case, this fund can be treated as investment entity. Yeah, all of you clear on this? Clear on this point? Any questions, any doubts? No? Yeah. So whenever you get any such type of entity, I think the first and the foremost which you can check always is the business objective, because that will provide you a perspective of whether to move into that direction or not. Okay, yeah. Now moving further. Moving further on to the exit strategies. Exit strategy means how to move out of that investment. Now, one feature that differentiates investment entity from other entities is that investment entity does not plan to hold its investments indefinitely. So what does it mean? Let's suppose if there is an investment entity. This, let's suppose, invests in equity shares of a company. So we can say, let's suppose this is investing in P Limited. Okay, yeah. And as compared to this, let's pick up another entity. Yeah, let's suppose that is also holding investment in P Limited. Now, these two parties or these two investors are holding shares of P Limited. Now, how do we try to first of all get into a situation so that we make out whether this entity will become investment entity or not? That is through the exit strategy. See, in case you want to hold some investment for strategic purpose. What is strategic purpose? Maybe you want this entity to be a sort of subsidiary for you. In such a case, what is your business objective? In case of a subsidiary, your business objective will not be to earn capital appreciation or investment income from the subsidiary. No. It will be more of a business purpose which is other than from these two primarily. Means the prime business objective will not be to earn capital appreciation or the dividend income, no, but to move into a direction which is aligned with the business of this entity. Correct? Yeah. And that is why whenever you will see such type of investments, these will be more of or generally long term rather than short term. And again, there is no criteria to define what is a long term or what is a long or a short term investment. This has to be assessed on the basis of understanding of the investor in relation to its investments in the investee. And that is how we can also try to now make out whether this entity will become investment entity or not. Okay. So now first thing that we understand is that investment entity generally does not plan to hold its investments indefinitely. What we see in case of other investments. They will generally have an exit strategy. Exit strategy means how to move out of this investment. Means they will reap the benefits for a short period of time and then will exit. An investment entity shall also have exit strategy for any debt instruments that have potential to be held indefinitely, for example, perpetual debt instruments. Okay. Now, exit mechanisms that are only put in place for default events, such as breach of contract, non-performance, are not considered as exit strategies. What does it mean? See, exit strategy means when the entity is investing in P Limited, on that very day, it should be clear that after some period, it will move out of this investment. Yeah, means that exit plan should always be clear. Let's suppose for this entity, exit plan is available. And what does the exit plan say? That in case there is any breach in the contract, if there is non-performance on the part of the by either of the parties, then the contract will sort of get ended, will get terminated, and that's why this entity will be exiting the business. Now, such type of clause is not really meant for exit. That is a kind of protection which is available to such type of investors. So this does not indicate their intent to exit, but to ensure that the terms and conditions which have been agreed continue to be fulfilled. Okay, yeah. That's why whenever we look at the investment entity, we should also look at the exit strategy which they might have opted at the time of making the investment, which can be of various types. Let's understand. Now, these can be for various types, and these various types will depend on the type of investments they make. So let's see. For investments in private equity securities, for investments that are in equity but are in public market, or for real estate investments. So these are various types of investments which can be made by them. Okay, yeah. And let's now understand with the help of one example as to how this exit strategy can be assessed by us. So we'll now pick up another example to understand this exit strategy. ABC Limited is established with primary objective of investing in equity shares of various entities across various industries based on detailed research about each industry and entities within the industry being done by the investment manager of the company. So ABC Limited has been set up, and this will build a portfolio of various investments. After due research, they will build the portfolio. Investment manager will be handling the portfolio. Obviously, investment manager decides the timing as to when the investment should be made considering the current market situation. Sometimes the investment manager decides to invest the idle funds into short-term to medium-term debt instruments with fixed maturity. Exit strategies are in place for the investments done in equity shares, but the same is not there for investments done in debt instruments. You need to determine. So now this company ABC Limited is investing in two types. Equity shares of various companies. Okay, it is investing in this. And for equity shares of various companies, all the investments which are made, they have an exit plan. Exit plan exists. But when ABC Limited invests in debt instruments, which are all short term or medium term, exit plan does not exist. Okay, herein we have an exit plan, but herein exit plan does not exist. You need to determine whether ABC Limited in the given situation fulfills the exit strategy condition, and therefore can this be considered as an investment entity or not? Yes, all of you. Now you need to answer this, please. Yes, quickly, all of you. I would now assume that you have Understood the question, and I'm hoping that this question once again is not very difficult. Quickly, tell me what should be the answer here. What should be the answer? Should this be considered as investment entity or not? Tell me quickly, should this be considered to be an investment entity or not? Yes, quickly, huh? Chavi Singh said for equity shares condition is fulfilled, but what about this entity? So do you mean to say that for debt instruments this condition is not fulfilled? If that is the case, will you call ABC Limited as an investment entity or not? That's the question. Yes, all of you. I'm waiting for a response. So should we go to the solution then? Yeah? Okay. Now, if you look at this entity, and we are not sure about all the conditions in relation to an investment entity, so we'll analyze it from the perspective of its investment for a short-term or a long-term period only, or from the criteria which requires that the investment should not really be for a long period of time or should have some exit plan. As regards this part of the portfolio, exit plan is very clear. And that's why if you look at this part of the portfolio, we don't have any objection in saying that ABC Limited should become investment entity. But if we look at the debt instruments, for the debt instruments, there is no exit plan. However, do we really need an exit plan specifically for the debt instruments? Let's understand. See, the debt instruments have a fixed maturity period. And that maturity period is again not a very long term. It's a short term and medium term period only. That means after that period, automatically these instruments will get redeemed. So there is an automatic exit plan attached to all of these instruments. So that's why we don't need any specific exit plan. And that's why even for this part of the portfolio, we can say that yes, it's a kind of exit plan which is available, and that's why there's absolutely no problem as far as this assessment of exit plan in both the types of portfolios are required to be considered. And therefore, ABC Limited can easily be considered as an investment entity. Okay. Then Chavi is saying, sir, for debt instruments, there is fixed maturity and hence ABC is investment entity. Very good. And that's the correct answer. Okay. Yeah. Now moving further on to the investment entity. See, so far, please remember that we have been discussing about investment entity only. Means what do they do, how is investments, and various points. We have not yet discussed anything in relation to exemption. Yeah, please remember that. Now moving further on to the earnings from the investments in relation to an investment entity. What should be the earnings? Once again, I'm hoping that you would now remember capital appreciation or investment income or both. An entity is not an investment entity if the entity or any other member of the group containing the entity obtains or has the objective of obtaining other benefits from the entity's investments that are not available to other parties unrelated to the investee. Now, what are those other benefits? Let's understand. So these are available on page number 14.49. So if you want, you can just look at all of these points quickly. So what are those benefits which at times may be availed by them? Acquisition, use, exchange, or exploitation of processes, assets, or technology of an investor. Joint arrangements or other agreements between the entity and another group member and an investee to develop, produce, market, or provide products or services. Financial guarantees or assets provided by an investee for borrowing arrangements of the entity or another group member. However, an investment entity would still be able to use an investment in an investee as collateral for any of its borrowings. Yeah. Now let's move on to illustration number 22 to understand around all of these different types of returns or benefits. So let's move on to illustration number 22. PQR Limited is established with primary objective of investing in equity shares of various pharmaceutical companies which are involved in research and development of medicine for a critical illness. So this will invest in pharma companies. That's the purpose. DEF is a fellow subsidiary of PQR, and DEF has entered into contractual arrangements with all the investees of PQR that in case they are successful in developing the medicine, then they will transfer the patent and distribution rights for that medicine to DEF. So let's suppose there is an investor who holds investment in PQR. Yeah. And this investor holds investment in DEF. This is I1. This investor has control over PQR, control over DEF. And let's suppose for PQR, there are various other investors. Yeah. I2, I3, I4, I5. Now, in relation to the pharma companies wherein PQR is making investment, which can be multiple, P1, P2, P3, P4, P5, P6. With all of these pharma companies, with all of them, DEF has a contract. What's the contract? That in case any of these companies is able to get the medicine, then the transfer of patent and distribution rights by any of these companies which finds that medicine will happen to or will be required to be done to DEF. Okay. And this transfer to DEF will be done at less than market price. So it's a sort of benefit which gets passed on to DEF. Okay. This arrangement is explained in the following diagram. Yeah. So diagram is available in the question period, and I have also tried to create the diagram. We need to determine whether PQR can be classified as investment entity. Yes, all of you. Before we get on to the solution, do you want to attempt this? Can you answer this? Whether this can be considered to be an investment entity or not? Yes, quickly. Tell me, what should be the answer? Can we say this will become an investment entity? Yes or no? I'm waiting for a response. Will this become an investment entity or not? Quickly. Will this become an investment entity? Yes or no? Anjali is saying no, sir. Nanda Usha is also saying no. And I think this is very, very clear. We just discussed that investment entity should get only one thing from its portfolio: capital appreciation or investment income or both. Correct. This is investment income. Yeah. Now in this case, PQR no doubt is getting either of this from its portfolio. But if we look at the PQR is a part of this group. So we can see that it's a group. Why? Because PQR has DEF as its fellow subsidiary, and that's why we can say it's a kind of group which has been created. And a benefit is passed on to this group. What is that benefit? That any patent, any right, etc., in relation to this investment, other than these two returns, is also getting passed on to this group at below market price, which is not allowed. Or if that happens, that will not let PQR remain as an investment entity or maybe get qualified as an investment entity. So that's why in this case, PQR will not be considered to be an investment entity. Clear? Chavi also answered the same thing. Chavi said, sir, it's not possible because it's a subsidiary of DEF. I think that's what you need to just, sort of rectify. That PQR is not a subsidiary of DEF. PQR is a fellow subsidiary of DEF. What is fellow subsidiary? Means two entities are subsidiaries of the same entity. So I1 has PQR as the subsidiary and DEF as the subsidiary. That is where PQR and DEF become fellow subsidiaries. Okay. Anjali is saying, sir, this was not possible because return is not in the form of capital appreciation or investment income. It goes beyond that, and which gets passed on to the group. So this return may not be getting passed on to PQR, but to the group it is getting passed on. So that's why this will not be an investment entity. Okay, yeah. So we can also look at some examples now before we move on to the exemptions. So these examples are available on page number 14.53, and these are all related to various conditions, etc., for investment entities that we have discussed. An entity has issued two types of equity shares to its investors. Class A, Class B. Holders of Class A are entitled to receive 10% of the profits of the entity. So you can say I1, this is holding Class A equity shares. I2, this is holding Class B equity shares. Okay. Holders of Class A are entitled to 10% of the profits of the entity at the end of each year. So they get 10% of the profits. After distribution of such amount, the balance amount is distributed proportionately between holders of Class A and Class B. So after this profit is distributed, then the profit gets distributed between A and B on a proportionate basis. So that means it's the preferred dividend which Class A equity shares get now. Such method of distribution of profits to the shareholders would not preclude the entity from being an investment entity if other conditions are satisfied. Now, if we are looking at this entity, there were certain criteria which this investment entity or this entity has to fulfill to be called as investment entity. And what was the criteria? That this entity will provide some returns to its investors. Now the investors are getting the returns, and those returns are again what? Only those returns which are permissible. But one class of investors is getting preferred right in terms of getting the returns over other investors. So will that be a problem? The answer is no. Okay. Let's look at another example. Example number 7. An entity has issued compulsorily convertible bonds with fixed interest payments to the investors. CCDs have been issued. Compulsorily convertible bonds. Sorry, it's CCB. Compulsorily convertible bonds. Such bonds are convertible into variable number of equity shares and hence classified as financial liability. Remember? Yeah. The compulsorily convertible bonds expose the investors, both the investors, to variable returns, because after conversion, the investors will have right in net assets of the entity, which is dependent on fair value of the investments done by the entity. Now, in this case, we need to assess whether the investors get exposed to variable returns of this entity or not. And at one point we may think that these are bonds. Bonds are legally considered as debts. Even if we look at the accounting requirements, these debts will continue to remain as debts. Why? Because conversion option requires number of equity shares to be variable. Yeah, that's not fixed today. So fixed for fixed criteria is not met. So even if we look at the accounting terminology or as per the accounting, today when the instruments are issued as per accounting, they will become financial liability. And if we look at the legal form, they are no doubt a debt. So that means from both the perspectives, these are considered as debt. But still, we cannot ignore the fact that in future, when the bonds will get converted into equity, in future, what will happen? These investors will get equity shares of the entity. And that is when the investors will get exposed to variable returns of the entity. Okay, yeah. Now we can move on to the exemptions. Anandi has a question in between. Anandi is asking, sir, how to get practice questions? I didn't understand your point, Anandi, when you say how to get the practice questions. If you are looking at the questions, then there's a big pool of questions available in the study material itself, which you should try to practice. Or if you are asking about how to practice questions, then of course, after going through this concept, some of the questions we have been practicing, some of the questions I am giving you for homework, and some of the questions I am not giving you for homework, but you know they are there in the study material, which I have asked all of you to make sure you practice. So that's implied homework for all of you. And even the questions that we have been solving in the class, I am suggesting that you should solve all those questions once again on your own. Yeah, that's the way to practice the questions. Now moving on to the exemptions attached to investment entities. So what are the exemptions? I would suggest if you can go to page number 14.53. An investment shall not consolidate its subsidiaries or apply Ind AS 103 when it obtains control of another entity and measure investment in a subsidiary at fair value through P&L. This is an exemption which is available to investment entity. That means investment entity will not be required to do the consolidation. Instead, what will it do? Instead, it will measure all of its investments at fair value through P&L. So let's understand. This entity has got multiple investments. See S1, S2, S3, S4, S5. Now it's been established that this company which holds shares of these companies is an investment entity. Ideally, i.e., that means this company should have done the consolidation of all of its subsidiaries. But there is an exemption. What does it say? That this consolidation should not be done. Instead, all of these investments will be measured in the standalone financial statements of this entity at fair value through P&L. If an investment entity has a subsidiary that is not itself an investment entity. Now, let's suppose if an investment entity has a subsidiary. Now, this is a subsidiary. And this subsidiary is also not an investment entity. Means this is not an investment entity. Only this is an investment entity. Because it's possible that all of these companies may also be investment entities. And the purpose and activities of this entity or this subsidiary are providing services related to investment entities, investment activities. Okay. It shall consolidate that subsidiary and apply the requirements of Ind AS 103 to the acquisition of any such subsidiary. So let's understand this once again. If an investment entity has a subsidiary, this one, that is not itself an investment entity and whose, so we are saying this is not an investment entity. Okay, I'm talking about this one. And what's the business purpose? What are the activities of S1? And the purpose and activities of S1 are providing services related to IE's investment activities. It provides services related to investment activities of IE. Okay. In such a case, it shall consolidate all such subsidiaries or that subsidiary. So now the exemption of not consolidating this type of subsidiary goes off. Means IE will have to consolidate this type of subsidiary. So it will not consolidate this one. This will not consolidate this one. This one also is exempt. But exemption is not available for S1. Okay. Provided S1 meets both these criteria, A and B. Yeah. And for your notes, you can just change it. S1 is not an investment entity. And I can also put the name for this investment entity. Say this is H. And therefore, we can also change this to H. Okay, clear on this? If the subsidiary that provides investment related services and the activities in itself an investment entity, then the investment entity parent shall measure that subsidiary at fair value through P&L. Obviously, a parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity subsidiary, unless the parent itself is not an investment entity. So let's understand what does it mean. So we have H. Below H, we are saying we have multiple investments. And we discussed that H will not consolidate S2, S3, S4, S5. and H will not consolidate S1, but H will have to consolidate S1 if S1 meets both these conditions. Okay, now a question arises that H is not consolidating these subsidiaries, that is okay. But what about the parent of H? Let's suppose there is a parent of H, P. Will P also not be required to consolidate H? Now the question is, will P not be required to consolidate H? You were saying this was investment entity, this was investment entity, this was also investment entity, this was also investment entity. Now in the given case, if P is also an investment entity, then P will also not do the consolidation. But if P is not an investment entity, then P will be required to consolidate H along with all of its subsidiaries. Clear? Yeah. Exemption is available only to investment entity. So if P is not an investment entity, then P is not getting that exemption, and therefore P will be required to consolidate not only H but all of its subsidiaries. Okay, clear on this? And for your reference, this explanation in the form of a chart is also available in the study material on page 14.54. Okay, clear? And we can also understand this in a better manner with the help of one example, which is available on page number 14.54 once again. And this one now needs to be answered by you, please. This one needs to be now answered by you. Okay, all of you ready? HTF Limited was formed by T Limited to invest in technology startup companies for capital appreciation. So there was T, then we got HTF. T Limited holds 70% in HTF. And controls HTF. Other 30% interest in HTF is owned by 10 unrelated investors. Other 10 investors. They hold 30% in HTF. T Limited holds options to acquire investments held by HTF at their fair value, which would be exercised if the technology developed by the investees would benefit the operations of T Limited. Now, T Limited has invested in technology startup companies. So we need to say T Limited, let's suppose, has invested in all of these companies. This is S4 and this is S1. Now, there is an option available to T. What's the option? that it can acquire any of this company from HTF. Okay. When, if the technology which is developed by any of these companies would be beneficial to T, but such an acquisition, if made by T, would be at fair value. Okay, it's not below market value, that will be at fair value. No plans for exiting the investments have been identified by HTF. So HTF doesn't have any plan of exiting these investments. HTF is managed by an investment advisor that acts as agent for the investors in HTF. So there is an investment manager. Who works as per the directions of these two investors, or you can say these investors. And that's why this investment manager has been considered as an agent and not the principal. We need to determine whether HTF in the given case is an investment entity or not. So before we get on to the solution, it will be good if you can just think through and let me know what is your assessment. Quickly, huh? Tell me, what do you think in this case HTF will become investment entity or not? Yes, quickly. I'm waiting for a response. Please tell me whether HTF will be an investment entity or not, and with reason. All of you, I'm waiting for a response. Quickly, huh? Yes, think about it. All the things that we have discussed about investment entity are required to be applied. So if you apply all of those concepts over here, you will get the answer easily. Okay, great. I've started receiving your responses. Anjali is saying, yes, sir, it's an investment entity because it measures its investments in the subsidiaries at fair value. Very good. What about others? Chavi is saying, no, sir, because it also provides benefits to T Limited. Okay, this is again good. Any more responses from your side? So let us first of all analyze the responses which have been received by me. First response which you are saying is that it measures its investments at fair value. I don't think anywhere in the question it's specified that HTF measures these investments at fair value. See, in the exam, I'm just again, helping you with some examination tips, and which is once again very important for all of you. In the exam, only the knowledge of concept will not help you. And this has been the biggest problem. And that's why maybe you can do this. You can just make a note at the beginning of your notes. Huh? So this point should not get lost somewhere within the notes or in between your notes. Maybe on the top sheet, wherever you are writing your notes, your register, your your diaries, etc. You should write this point that in the exam, it's not only the knowledge of the concept which is important. It's very, very important that we read the question carefully. I can tell you that in the exam, it has been noticed that majority of the mistakes have not been made because the student doesn't know the answer, but because the student doesn't read the question carefully. It may be that you have a very limited time, that's why you read the question carefully. Or maybe you just presume after reading a part of the question that the remaining part is also sort of moving in the same flow, which you may think upon. Yeah, this is the biggest problem. This is something which you need to work on. For example, if Anandi asks me how to get practice questions or how to practice questions, I would say, whenever you practice questions, just make sure that you give adequate time to reading of the question. See, in the exam, what does it matter? Answering the questions. And in the exam, it's not only the solution that matters, it's the question that matters more than the solution. Yes or no? That's why it's very, very important that you give due respect to the question. And that is only possible when you give adequate time to reading of the question. So whenever you plan for answering the question paper, you give time slots. Is that correct? Yes or no? You give time slots. This is something which you prepare as your strategy, that I'll answer this question in this much time, this question in this much time, or maybe all the questions in this time slot. Whenever you do that, please reserve time, dedicated time for reading of the question. If you do that, once again, you will see that the accuracy of your solutions will increase significantly. Okay. Now coming back to this question, there are a couple of responses I received. I'll just tell you. Nowhere in the question it's written that the investments are measured at fair value, which has been considered by you as the reason, first of all. And again, it's not specific to the student who has shared this response, because this is something which will apply to all of you. Many of you will be thinking about it, even though you have not shared. Okay, but it's important that you share, so only then we can understand the problems which are possible. Number two, the response says it provides benefits to T Limited. Now, what is the benefit which is provided to T Limited? That benefit is in the form of acquisition by T Limited as and when it requires. This exists in the question. Now, coming back to the solution. We see two problems in calling HTF as an investment entity. What's the first problem? First problem is the benefit which T will get. See, if you look at T and HTF, it's a group. So T is getting some benefit which is other than capital appreciation or investment income. Yeah. Because of which HTF should not become investment entity. Number one. Number two, if you look at HTF and its portfolio, no exit strategy is available. We may say, or you may say, sir, can we not consider acquisition of S1 by T as an exit plan of HTF? Because in a way, if any of the subsidiary gets acquired by T, HTF has exited. Yes or no? See, this could have been the case provided T was not in the same group where the HTF belongs, because it's the same group. That's why we will still not be able to say that it's an exit plan which is available with HTF right now. So the missing exit plan, missing exit plan for HTF and the additional benefits which T is getting from this arrangement will make HTF as not an investment entity. Clear? All of you? Yeah? So with this, we can put an end to our discussion to investment entities. This is once again considered to be important topic for the purpose of examination, because in the examination, if the examiner will have to test your knowledge around the exemptions available, then only two ways are possible. One, which we discussed earlier, wherein 4 conditions are required to be fulfilled together, and second is through investment entities. Okay, clear? All of you? So now before we move further on to the next topic, if you have any questions, any doubts, please let me know. Any questions, any doubts in case you have? Yes or no? No? Okay, so now we are starting with another unit, and it's a continuation of consolidation. Now, what we are going to do is about the consolidation procedures. So far, all through, we kept discussing about assessment of an investment, wherein that investment was in the nature of a subsidiary. Now, having understood that subsidiary has been acquired, we now need to get into the accounting requirements. Means we now need to get into the recognition, measurement, presentation of the subsidiary in the consolidated financial statements. So that means we'll get into the consolidation procedures in relation to the subsidiary. Okay. So now, talking about the consolidation procedures, what do? Very simple. If we say H has got 2 subsidiaries, S1 and S2, consolidation works with a very, very simple procedure for group companies which have a relationship of holding and subsidiary. And that procedure is called as line by line consolidation. And this is something which you would have also read in intermediate. At intermediate level, you would have covered consolidation. That means under Indian GAAP, it's the same accounting requirement. I'm not saying accounting requirement as per Indian GAAP, that means AS 21 and Ind AS 110 is exactly the same. No. In relation to this line by line consolidation, the accounting part remains same. Means the method of consolidation remains largely same, with of course various changes like for assessment of control, which we discussed. Line by line consolidation means we will put assets, liabilities, P&L, cash flow, notes of H at one place, S1 at another place, S2 at another place, and then we will just simply add all these three. All these three will be added together. H plus S1 plus S2. Very simply, these will be added together. This is called as line by line addition. Okay, yeah. The resultant part will be what? The resultant part will be total, or you can say consolidated financial statements of H Limited. Who is preparing the consolidated financial statements? Please remember, it's again very, very important. S is not preparing CFS. S2 is not preparing CFS. Who is preparing the CFS? It's the parent company. So, consolidated financial statements will be considered to be that of the parent and none of the subsidiary. Whose responsibility is to prepare the consolidated financial statements? It's with H. S1, S2 don't have the responsibility to prepare consolidated financial statements. So when we say that CFS is now ready, means it's ready for H. But in this CFS, wherein we have discussed about line by line addition, many other adjustments are also required to be incorporated. Means after this line by line addition and before calling this addition as CFS, we need to make some adjustments. We need to make some adjustments. So if we say this total is, say, I or first, and this is his second. So the final result of adjustments made into this column will give us the consolidated financial statements. Now, what are these adjustments? This will also require understanding of various points. Okay, so we don't really have any one adjustment to be done over here. There are multiple types of adjustments which will be required to be done over here. Only after which we will get consolidated numbers to be called as a part of consolidated financial statements. So that means this total is only a step towards moving towards consolidated financial statements. Okay, yeah, understood the strategy that we are going to adopt in terms of reaching the consolidated financial statements. So the first step always will be line by line addition. Yeah, clear? Okay. Now, as a next step, we will move on to various adjustments, and as and when we'll complete one adjustment, we will be moving closer towards this consolidation. Yeah. Now, beginning with the adjustment number 1. Whenever consolidation has to start, so we'll have to just remember that business combination must have been done. Let me just take you back to our discussion on business combination. If let's suppose business was acquired on 1st of August 2019, so the consolidated financial statements were required to be prepared on 31st March 20. We understood that Ind AS 103 is required to be applied on this date, and consolidated financial statements will be prepared on 31st March. They will not be prepared on 1st of August, no, but they will start from 1st of August. Means, if we talk about the application of Ind AS 110, it will be for this date. Okay, yeah. Now, what do we need? We need this CFS on this date. Okay, but For this CFS to be achieved on this date, what do we need as the starting point? As the starting point, what do we need? We need all the numbers computations which would have been done and which would have resulted in NCI, which would have resulted in goodwill or capital reserve on the date of acquisition. Because if we don't get that, if we don't have that, can we just move further? No. We need to freeze this part first of all. Only then we can move towards getting the final consolidated numbers. Yes or no? Yeah. And you will be thinking, but sir, this part we have already covered. So that means adjustment number 2. Sorry, step number 2. That means adjustment number 1 is in a way done by us. Of course, yes. So we can say that step number 2 involves adjustments related to Ind AS 103. This part is already covered by us. We have already understood. We know how to compute all of these numbers on this date. Yes or no? We already know that. Yeah, we understand that, all of these things. But still, for the purposes of our discussion, what we can do is we can just go back to this computation because it's been some time and some of you may not have done the revision. So that's why it will be good to revise some of our concepts related to this point before we move further on to our steps and to different adjustments which exist over here. Okay, yeah. So for this, what we can do is we can pick up one small illustration on page number 14.58. Illustration number 1, in which we are required to make the adjustments related to Ind AS 103. And I'm just hoping that you will be able to solve this and share your answer very quickly with me. Yeah, because I don't really think that I need to solve this. I'm sure you will be able to solve this. Because it's only a revision that we have been doing right now. Fine? Yeah? Will you be able to solve this and share with me? Yeah? Okay. A Limited acquires 80% of B by paying cash consideration of 120 crores. So I'll clear this part. A Limited has acquired B by paying 120 crores. Fair value of NCI. What is NCI? 20% of B. Its fair value is available. That is 30 crores. Value of B's net assets as per Ind AS 103 are also available to us. What is that? 130 crore. You are required to determine the goodwill and also tell the journal entries that will be passed on the date of acquisition. You will be thinking why we are doing so simple questions, sir. In Ind AS 103, we solved so many typical questions. It's important for the purposes of our revision. Yes, quickly. You can just share your answer with me and it will be good. You can also share the journal entry. Yes, I'm waiting for a response. Over to you. Please share your response. Are you done? Okay, great. Chavi has shared. Chavi is saying it's 16. I'm not sure what 16 you have computed. I think it's goodwill, I guess. Yeah. What about others? In this case, we first of all need to compute goodwill or capital reserve. Anjali has also solved this, and Anjali is saying so the goodwill is 20 crores. So let's solve this. See, how do we compute goodwill? We compute goodwill by picking up the purchase consideration from which we need to reduce fair value of net assets. But in this case, we also have NCI. So what do we need to do? In the purchase consideration, we need to add the value of NCI. So the purchase consideration is 120 crore. 120 crore. Why I have written it twice? Because NCI can be computed using two methods. One, at its fair value, which is available in the question. What is the fair value of NCI? 30 crore. So if we pick up fair value of NCI, then it's 30 crore. Or the other option is to consider proportionate share of NCI. What is the share of NCI? 20%. 20% of net assets of 130 crore. So 130 crore into 20%. What do we get? 130 crore into 20%, we get 26. Okay, yeah. From this, what do you reduce? Fair value of net assets. It's 130 and it's 130 under both the methods. So finally, the amount that you get is either 20 or 16, and both the numbers are positive, therefore they will become goodwill. So both the methods are permissible as per Ind AS 103. Now we need to pass the adjustment entry. So who will pass the adjustment entry in this case? A. Because A is acquiring B. So what will A do? Let's look at the accounting entry of A. A will say net assets debited 130 crore. And A is required to pay cash to bank 120 crore. Yes or no? A is required to pay cash 120 crore. Now, if we look at A, what is the share of A? Only 80%. Ideally, he should have acquired only 80% of net assets. But what has he done? He has picked up all the assets with himself. Is that appropriate? Is that appropriate to take the assets of other parties? Not at all. So what will A be required to do? A will require to show a liability towards those other parties. Yeah? In the form of NCI. So A will, now this will vary. It will either become 30. If it becomes 30, then A will get goodwill as the balancing figure of 20. Or this may become 26, in which case this goodwill will become 60. Clear? Clear on the accounting entry which will be passed by A in the books of A Limited. All of you clear on this? Yes or no? Clear? So before we move further, we can practice with one more illustration related to this part we have covered earlier. So we can go to illustration number 5. And this is once again we have covered, and similar sort of adjustment we have covered, but still for the purposes of our revision, we'll solve this question. So we can go to page number 14.63, illustration number 5. And once again, I would request all of you to please solve this and share your answers now. RS Limited holds 30% stake in PQ Limited. This investment in PQ, RS has 30% in PQ. This investment in PQ is accounted as an investment in associate in accordance with Ind AS 28, which we have not read. And the carrying value of such investment is rupees 100 lakhs. RS Limited purchases the remaining 70% stake for a cash consideration of rupees 700 lakhs. So it acquires another 70% for a cash consideration of 700 lakhs. Fair value of previously held 30% stake is measured to be 300 lakhs on the date of acquisition of 70% stake. Value of PQ's identifiable net assets as per Ind AS 103 on the date of acquisition is 800 lakhs. You are required to compute goodwill or capital reserve and publish the accounting entries in the given case. Quickly, can you just compute the amount of goodwill and tell me the accounting entries quickly? Over to you. I think this is again a very simple question. Similar question we solved earlier. You remember? Shall we share the accounting entry earlier with me? So similarly, you all can share the accounting entries also. Chavi has solved this. Chavi is saying that goodwill comes out to be 200. And can you also tell me the accounting entry? Yes, so in this case, how do we compute this? Purchase consideration, 700 lakhs. But this purchase consideration is only for 70%. What about 30%, which is previously held equity interest? We need to consider that at fair value on the date of acquisition, which is given as 300 lakhs. Previously held equity interest. Previously held equity interest 300 lakhs. From this, do we have any NCI? No. So from this, we reduce fair value of net assets. And what is the fair value of net assets? 800 lakhs. So what do we get? 200. This is what? Goodwill. It's positive, so goodwill. Now, what will be the accounting entry? So RS will say net assets debit. It is getting 800 to bank. What is the payment by RS in this case? Yes, tell me. What is the payment by RS in this case? 700 lakhs. Okay. Now, what do we do? Now, what do we do with this previously held equity interest? This goes off. This will not remain anymore. And why do we do that? Because now there's no investment in associate. All the investment is now in the form of investment in subsidiary only. So what will happen? This investment in associate which existed earlier, this will be derecognized. And what was the value of this investment in associate? This had a carrying value of 100 lakhs. So what do? We will say to investment in associate 100 lakhs. This goes off. But when it goes off, it has a fair value of 300 lakhs. So we'll say to gain on fair valuation of previously held equity interest 200 lakhs. Okay, yeah. And the net amount which remains will be what? Goodwill, which is nothing but the balancing figure 200. There's no NCI in this case, so that's why it's not required to be incorporated, because this accounting entry is passed not on this date but on this date when the 100% is acquired or when the control is acquired. Because you may be thinking, but sir, on this date there was NCI. No. And actually on this date, who was the NCI? RS was the NCI on that date. All of you clear on this? Any questions, any doubts in case you have on this, please let me know. I received responses from Anjali and Chavi shared the accounting entry in relation to this, which is good. Any more questions in case you have on this, please let me know. Because we'll now take a break, and after the break, we will now move on to more adjustments. So this adjustment was once again in relation to preparation of CFS. But fortunately, we had already covered this adjustment earlier. So this was more of a revision for us. And that's why we didn't find anything new in this. And you all were thinking, sir, why we are spending time on this? Let's move further. This appears to be very, very easy. Is that true or not? Yeah. And this appeared to be easy only because we had done this earlier. Okay. Yeah. So now after the break, we will continue and we'll start in relation to this different type of adjustments part. Okay. Any questions in the meantime? In case you have, please let me know. Any questions? Any doubts? Yes or no? Okay, so let's go for the break. And in the meantime, if you have any query, you can just start sharing your queries also. Yeah. Hi, welcome back. So we'll now start with another adjustment, and this is in respect of accounting policies. Now, at times, it may happen that two companies do not have same set of accounting policies. For example, there is a holding company H and a subsidiary S. Say for inventory valuation, H follows the weighted average method and S follows FIFO. FIFO means first in, first out. Okay. Now, if we look at their separate financial statements, it's okay. They may have different accounting policies, there is no problem. But when it comes to the consolidated financial statements, CFS of H. So there's a concept which is important to understand. And that concept is called as single economic entity. Single economic entity. You can say consolidation works on this principle. Principle of single economic entity. Now this means that whenever we consolidate various group companies, in our example, we have only two group companies, but it may be multiple group companies. So whenever we consolidate various group companies, we should assume as if all those are not different companies. They are not various companies. Instead, there is one economic entity. And that is how we need to do the consolidation. Step number 1, wherein we discussed line by line addition or line by line consolidation, is also working on the same principle. It follows the same principle that we don't have multiple entities now. It's a single group. Basically, it's a single group, or we can say it's a single economic entity for the purposes of preparation of financial statements. That is how we need to look at these two entities as if they are one entity and accordingly prepare their financial statements. Yeah, let's suppose it has got two more subsidiaries, S2, S3. We should now consider that there is one entity instead of four entities. And what is that one entity? Mix of all of these four, or you can say combination of all of these four. Okay, yeah. This is called as principle of single economic entity. Now, while following this principle, one challenge may arise, that is about different accounting policies being followed by different companies. So we understood that S was following FIFO and the method followed by H was different from FIFO. Therefore, what will happen? When we will do line by line addition of H and S, H will have inventory of 100 and S may also have inventory of 100, which will become 200 and which may appear okay to us. Why? Because we may think that we have added these two and we have kind of created one single economic entity. But will it be right to do the addition like this? No, because there is inconsistency. If you look at the users of the financial statements, he will get a misleading picture. Why? Because he will understand as if the group has inventory of rupees 200, but using which accounting principle? It may happen that this inventory of S, if it follows weighted average method, then it changes to 90. Now, in the financial statements of the group, some valuation of inventory method will have to be given as the accounting policy. Now, if we give that as weighted average, then amount of rupees 200 for the group as a whole is inappropriate. If we give accounting policy as FIFO, there again total of 200 may not be appropriate, because if H is required to follow FIFO, then once again its valuation may not be 100. It will change. So that's why what should be done? That's why to have consistency, to have the right number reported in the group's financial statements. Groups means consolidated financial statements. Uniformity of the accounting policies of the group companies is mandatory. So that's why, as a next step, it is important that the accounting policies of the group, currently for our purposes, group includes only holding and subsidiary. We are not talking about joint ventures. We are not talking about associates. For the time being, we are discussing only about subsidiary. So that's why we can now say that accounting policies of the holding and the subsidiary should be consistent, should be uniform. Only then the consolidation may happen, otherwise not. If in case subsidiary is having different accounting policies, yeah, maybe subsidiary says no, I will follow different accounting policies, that's okay. Even in that case, for the purposes of consolidation, subsidiaries accounting policies should be changed to align them with the accounting policies of the group. Clear? All of you? Yeah? Let's look at one example now. Illustration number 6 to understand this. Page number 14.65. Illustration number 6. And you can also note down your homework. Before we move on to this illustration, I'll just write down your homework also. Page number 14.59. What is illustration number 2, 3, and 4? Okay, please note down your homework. And I think you can also add illustration number 7 to this. 2, 3, 4, and 7 to your homework. Okay. So now we will move on to illustration number 6. PQR is the subsidiary of MNC. So we have MNC and then PQR. MNC has control over PQR because only then PQR will become its subsidiary. In the individual financial statements, individual means standalone, prepared in accordance with Ind AS, PQR has adopted SLM method of depreciation. It follows SLM method of depreciation. and MNC has adopted written down value method for depreciation. It follows WDV for depreciation. And it's depreciation of PP. As per Ind AS 110, parent shall prepare CFS using uniform accounting policies for like transactions and other events in similar circumstances. How will these PPE be depreciated in the CFS of MNC, which is prepared as per Ind AS? So you need to comment on this situation. Tell me quickly, what is your answer? Around the alignment, can you quickly comment what should be the answer in this case? How will the consolidation be done in the given situation? Over to you. Quickly, huh? I'm waiting for a response. Chavi is saying, sir, it's an accounting estimate, not an accounting policy. So what does it mean? If you can complete this part. For the purposes of consolidation, now what do we need to do? If you would have covered in day 16 EPE, you would be knowing this. And I understand that you have already covered in day 16. So I'm hoping that you remember this point and you will be able to comment on the consolidation requirement accordingly. I'm awaiting responses from all of you. You need to answer this fast, please. Yes, quickly, huh? What do we do in this situation? Tell me, all of you. What do we do in this situation? So how will the consolidation be done? Should we change the accounting method of PQR? Should we change the accounting method of depreciation of MLC? Or this is not required to be changed for any reason? All of you need to tell me. Yes, quickly, yeah. So should we go to the solution? Yeah. Okay. Now, in the given situation, we can see that different methods of depreciation have been chosen. There are different methods of depreciation by two companies of the same group, which are required to consolidate their financial statements. Now a question arises that before consolidation, accounting policies should be aligned. Therefore, we need to now understand whether this method of depreciation needs to be aligned with this method of depreciation. Correct? Yeah. Now we understand that the method of depreciation is not an accounting policy. Sorry, is not an accounting policy. What do we call it as? It's an accounting estimate. It's not a method of depreciation. Sorry, it's not an accounting policy. If this was an accounting policy, like for inventory we discussed, FIFO and weighted average method are what? They are accounting policies. But herein, these two methods are not the accounting policies. So that's why If those are only accounting estimates, then they can definitely be different for different entities. And there is absolutely no requirement to align these two methods of depreciation for the purposes of consolidation. Therefore, in the given case, consolidation can be done by having different methods of depreciation in respect of two group companies which are doing consolidation. Okay, clear? All of you? All of you clear on this? Chavi completed this answer. Chavi said, therefore, sir, it will not be required to just go for, no adjustment will be required and we can just go for line by line simply without doing any adjustment. Anjali said two methods can be applied separately. Why? Because these were not the accounting policies. These were only the accounting estimates. Okay, yeah. So now moving further. Moving further, we'll now talk about accounting of potential voting rights which are held in a subsidiary. So you can go to page number 14.67. Say there is holding company having 60%, or instead of 60, let me just say it's 35% shares of B. Yeah, it is having 35% shares of B. The remaining 65% shares are held by others. A also holds an instrument of B which carries potential voting rights, and it's been established that if this instrument is exercised, or that means that by holding these potential voting rights along with 35% shares, A has control over B. Yeah, this is something which we have discussed already. How is this possible? Correct. Now a question arises that in the consolidated financial statements, we will do line by line addition, and we'll also pick up a minority equivalent to 65%. And now you may be wondering, sir, how can minority be 65%? What is minority? NCI. How can NCI be 65%? Sir, ideally it should be lower. In this case, NCI is higher, which is okay. As I told you, under Ind AS, percentages don't matter. What matters is those three conditions, on the basis of which investor gets control over B. Even with 1% shareholding, A may get control over B. Yes or no? This is something we have already discussed. Now, we understand that NCI will be 65%, which means in the consolidated financial statements, 35% will be the share of A. Now a question arises that do we need to consider the accounting in the consolidated financial statements after considering the impact of conversion or before considering the impact of conversion? Means, let's suppose this instrument was compulsorily convertible debentures. These have not been converted as yet. No. On the date of acquisition, when the control has been assessed, they continue to remain CCD. Even after the date of conversion, means on the date of balance sheet, they continue to remain CCD. Okay. But on the basis of their exercisability, means they were currently exercisable, they were beneficial to be converted into equity. Therefore, A could assess that it got control over B. Now the question which we need to consider is that when we will do the consolidation, when we will prepare the consolidated financial statements, so we need to consider the percentage of A which will increase, let's suppose from 35 to 70 because of this potential voting right, and then do the consolidation, or we need to ignore this part at the time of consolidation. Understood the query, understood the point that we need to now consider. Okay, let's understand this. Proportion of profit or loss and changes in equity allocated to parent and NCI in preparing CFS is determined solely on the basis of existing ownership interests and it does not include possible exercise or conversion of potential voting rights. Means if due to conversion this would increase to 35%, sorry, this would increase by 35%, making it 70%, then this is not required to be considered while preparing the CFS. Let's try to understand this with the help of this chart. This is 31st March 20. This is 10 December 2019. Okay. On this date, A holds 35% in B and 65% is NCA. Now what we are saying here is that when the control will be assessed on this date, then we will definitely consider this factor. Means control assessment will include considering this point that if this gets converted, it may change to 70. Because of which A will be considered to be having control in B, and therefore A will be required to consolidate B in its consolidated financial statements. But when A will consolidate B, it will consolidate B only on the basis of existing ownership and not after considering the impact of possible conversion, because this conversion has not taken place on this date. Clear? Clear? Yeah? Okay. So if you have any questions on this, please let me know. Then we'll move on to the next type of adjustment. Yes. Then we'll move on to the next adjustment. Any questions in case you have on this? No? Do you have any questions on this? Yes or no? Shall we move further? Tell me quickly. This may be a point of confusion. That's why it's very important that if you have any query, to let me know now. Quickly. All clear? Okay, very good. So we'll now move on to the next step, means next type of adjustment, which may be required. Next adjustment is in relation to the reporting period of the parent and the subsidiary, which is again required to be aligned. So we have holding and a subsidiary. So the subsidiary has the reporting year as 1st of January 2020 to 31st of December 2020. This is the reporting year of subsidiary. Whereas parent H has the reporting year as 1st of April 2020 to 31st of March 2021. Okay. Yeah. Now, H has control over S. Therefore, H will prepare consolidated financial statements, and the consolidated financial statements will be prepared from 1st April 20 to 31st March 21. Correct? Now, for the purposes of consolidation, what will H do? Somebody from the office of finance team of H will call the finance team of S and will say, please send your financials so that we can do the consolidation. And they will require financial statement of S from 1st of April to 31st March 21. Obviously, because only then they will be able to do the consolidation. Yeah. But what will S say? S will say, how can I provide you the finances from 1st of April to 31st March? Because I don't prepare that at all. We prepare the financial statements from 1st of January to 31st December. S is doing all the accounting on a daily basis. There's no doubt. But the financial statements are not prepared on a daily basis. They are prepared specifically for a purpose. Now the matter is stuck. So how do we resolve this? And this again has become a problem. So how do we resolve this problem? In this case, standard says, ideally, the reporting period of the holding and the reporting period of the subsidiary should be same. Okay. But in case they are not same, then the maximum difference between the reporting periods of the holding and the subsidiary can be 3 months, which fortunately is there. So we should thank God. We should say thank God. Otherwise, what will happen? Otherwise, subsidiary will not have any choice but to report its financial statements for the same financial year which holding requires. Okay. In this case, subsidiary is saved. Why? Because the difference is only 3 months. So now what can the subsidiary do? Subsidiary can share the financial statements for the period which they prepare. Next, it may happen that during this period, certain significant transactions get carried out, or there are significant transactions in the books of subsidiary in these 3 months. Yeah, but will the subsidiary provide the financial statements including these 3 months? No, because these are covered in the exemption. Standard says 3 months. If are not covered, it's okay. It's okay to ignore these 3 months. Now it's a problem. Therefore, the standard says that it's okay to have a difference of 3 months. Means subsidiary can report its number to H, excluding these 3 months, but But even though subsidiary will not prepare the financial statements including these 3 months, subsidiary will have to report those significant adjustments to the holding separately, which the holding will be required to include in its consolidated financial statement separately. Means the difference of 3 months is permissible, but if there are significant transactions in those 3 months, then those are required to be considered, accounted for by H separately in its consolidated financial statements. Okay, clear on this? Clear on this point? Yeah. So let's look at one example now to understand some of these provisions. So we can go to page number 14.69. Illustration number 9. Let's pick up this illustration. A Limited, an Indian company, has a foreign subsidiary B Inc. So we can change it. A Limited, an Indian company, has a foreign subsidiary B. Subsidiary B has taken a long-term loan from a foreign bank, which is repayable after the year 2000 X9. However, during the year ended 31st March 2000 X2, March 2000 X2, so we are not aware of these things. Huh? So this is 1st of April 2000 X1, 31st March X2. During the year ended 31st March X2, it breached one of the conditions of the loan, as a consequence of which loan became repayable on demand on the reporting date. This is done by B. Subsequent to the year end, means after the year end, means during this period. But before the approval of the financial statements, B rectified the breach and the bank agreed not to demand repayment and to let the loan run for its remaining period to maturity as per the original loan terms. While preparing its standalone financial statements as per IFRS, B has classified this loan as current liability in accordance with IAS 1. It's not Ind AS, IAS 1. Okay. Now this is something which B has done. So we can say, we can put B over here. B has this financial year and this is the situation of B. Now I think this will look okay to you. Now in this case, tell me whether A Limited is required to classify such loan as current while preparing its consolidated financial statements under Ind AS. So now in this case, we don't get any different reporting periods. We see A and B are having the same reporting periods. Okay. So tell me, what will A be required to do when it prepares consolidated financial statements, wherein it consolidates financial statements of B? Yeah. Should we go to the solution? Okay. Now, as per Ind AS, whenever there is any breach of the loan, before the end of the financial year. So where there is a breach of long-term loan before financial year end, yeah, then the loan becomes payable on demand because of that breach. And in such a case, loan will become current liability. However, if the loan is sort of acknowledged by the bank after the reporting date, but before the approval of the financial statements, that the bank will not demand the repayment of loan. Yeah. Then as per Ind AS, an entity can continue to classify that loan as loan current. The above position under Ind AS 1 differs from corresponding position under IAS 1. Under IAS 1, when there is a breach of such type, which gets rectified in a way that bank approves it. So breach is on 31st March or prior to that. Bank has approved that it's okay to have the breach. I'll not demand the repayment, but the bank has approved it after 31st March. Even in that case, IFRS says, it's not Ind AS, that the loan will be continued to be called as current. If the bank has approved that prior to 31st March, then it's okay. But if the bank has approved it after 31st March, then as per IFRS, the loan will be considered to be current. Okay. Yeah. Accordingly, in the given case, the loan liability recognized as current liability by B in its standalone financial statements prepared as per IFRS should be aligned as per Ind AS in its consolidated financial statements and should therefore be classified as non-current in the consolidated financial statements of A Limited. Now, B will call it as current when it will prepare its standalone financial statements. But when A prepares CFS, then such a loan will become non-current in the CFS. Why? Because CFS is prepared not as per IFRS, but as per Ind AS. Okay? Yeah? Clear on this? All of you, if you have any questions, any doubts on this, please let me know. Yes, I'm waiting for your query. If any, please let me know. Tell me quickly. Any questions, any doubts in case you have, please let me know. So with this, we have also understood one adjustment that in case subsidiary and the holding are following two different gaps, means they are following two different accounting standards. IFRS is different from Ind AS. So that's why in the consolidated financial statements, alignment of policies or alignment of gap is also very important. And who will do that alignment? It's the parent who will do the alignment. Okay. Clear? Yeah. Clear on this? We can now also pick up illustration number 8. So this is page number 14.68. Page number 14.68, illustration number 8. How should assets and liabilities be classified into current or non-current in the consolidated financial statements when the parent and subsidiary have different reporting dates? Let's understand this. How can assets and liabilities be classified into current and non-current in the CFS when the parent and subsidiary have different reporting dates? So parent, let's suppose, has a particular financial year, subsidiary, let's suppose, has different financial year. Now subsidiary may be showing certain assets and liabilities as current on a particular date, which may not remain current or non-current if you look at it from the reporting date of the parent. Yes or no? So for example, on 31st of December, which is the reporting year of subsidiary, let's suppose an item has been shown as non-current. If we look at the status of this item on 31st March, that means 3 months later, will this item be continued to be called as non-current? No, it may change to current. Yeah, because current and non-current criteria are analyzed from the reporting date up to next 12 months. Okay. Now, even though it will be non-current, if you look at it from standalone financials perspective, but the CFS which will be prepared from 31st March instead of 31st of December, therefore, will it require any adjustment? So that's the question. Okay. Yeah. So let's understand this. How do we deal with this type of situation? Ind AS 110, you can go to the solution, please straight away. Ind AS 110 requires subsidiaries with reporting period end different from period end of the parent to provide additional information or details of significant transactions if it is impracticable to provide additional information to enable the parent entity to consolidate such financial information of the subsidiary at the end of the reporting period of the group. Appropriate classification of assets and liabilities as current or non-current in the consolidated financial statements has to be determined by reference to reporting period end of the group, which means if subsidiary has reported its financial statements of this period to parent. Okay. Now let's suppose asset 1, asset 2, liability 3, those are appearing as non-current as reported by subsidiary. Now these are the numbers reported by subsidiary, these are appearing as non-current. Now the parent will have to recheck whether these 3 will remain non-current on this date or will these become current on this date. If they become current on this date, then their classification will have to be changed. And for changing this classification, for doing this analysis on this date, some additional information may be required from the subsidiary, which the subsidiary will have to provide. Okay. Yeah. For example, so there's also an example which is given in the solution itself. A subsidiary with the financial year end of 31st of December X1 has a payable outstanding that is due for payment on 1st of January X3 and has accordingly been classified as non-current. The financial year end of the parent is what? 31st March X2. Due to the time lag, subsidiaries payable in the CFS of the parent will now become current. So therefore, this non-current liability will have to be shown as current liability when it moves to consolidated financial statements for the financial statements for the period ended 31st March 2000 X2. Okay, yeah, clear on this? Clear on this? Yeah. Yes, so let's move further. Let's move further on to the next adjustment now. This is in respect of dividend from the subsidiary and its impact on non-controlling interest. This is considered to be a very typical adjustment and very important adjustment when it comes to preparation of consolidated financial statements. So let's understand this adjustment. You may refer to this page, please, for the purposes of our discussion. Page number 14.70. Page number 14.70. All of it. Yeah. Let's get on to this adjustment and then we'll try to understand this in a better manner with the help of the example which is given. Okay. Yeah. This is considered to be a very important adjustment. This is in respect of dividend. And before we get on to this adjustment, let me just explain you certain principles, why that will be relevant. We discussed about consolidation wherein line by line addition is required. So let's suppose we have holding company H, then we have, let's suppose, subsidiary 1, let's suppose we have subsidiary 2. So they will have some numbers. As we discussed, line by line addition will be required. Okay. Then we get the total. And then one type of adjustment which arises is called as elimination of intra-group transactions. Okay, this is not really linked to dividend, but it has some principles attached to dividend. So that's why I picked up in between this type of adjustment. So don't get confused. So what is this adjustment? And this is very common. I'm sure all of you will be knowing about it because under Indian GAAP, you must have covered it. If let's suppose during the year, H has sold some goods to S1. Now we are looking at the financial statements of the group. Means this group, wherein we are not considering these to be three different companies. Instead, we are considering as if they three in a combined manner are equivalent to one company or one group. Yeah. And let's suppose if we prepare the financial statements of one company, one entity, and if an entity has various departments, and one department transfers goods to another department. You must have done departmental accounting also. And one department charges markup while selling goods to another department. So in the financial statements of the company, do we show that as revenue of one department and purchases of another department? No. That gets eliminated. Why? Because within the company, any adjustment if done will have to be shown on a net basis. Otherwise, that will unnecessarily inflate the revenues and the costs. And similar adjustments will have to be done for the corresponding assets and liabilities. Correct? Now, with the same principle, with the same understanding, if we are treating these three companies as a single economic entity, and if they are doing any transaction amongst themselves, what should we do? We should also eliminate such transactions. Means transaction between H to S1, transaction between H to S2, transaction between S1 to S2 should be eliminated. So if H has sold goods worth of rupees 100, so let's suppose H has a revenue of 1000. S1 will have a purchase, let's suppose, of 2000. If H has sold goods worth of rupees 100 to S1, then what do? That 100 will have to be eliminated over here. So when we do the total of these three, from the total, what should we do? We should exclude this revenue of 100. So that this revenue between the group company goes off. Similarly, if the group company, this one has purchased goods worth of rupees 100 from H, those should also be eliminated. So at one side revenue goes off, at one side purchases go off. All in all, it's neutral impact. But the revenues and purchases of the group at the combined level are now appearing at the right numbers. Correct? Yes or no? Yeah? Clear? Similarly, if there is any adjustment, other than this one also, if there is any adjustment between the group, that will have to be eliminated. Now, while preparing the consolidated financial statements, this becomes one of the most challenging exercises. Why? Because if you look at the elimination is all mathematical. It's not difficult to be done. It can be done very, very easily. But for the purposes of doing this elimination, identification of such transactions which exist between the group is a difficult exercise. Or you can say is an exercise which is required to be done. Because if we by chance miss out in terms of identification of any such transaction, then that will not get eliminated. Yes? Yeah? Correct? So therefore, whenever you get any question of consolidation, you will also have to be very, very careful. Question will not tell you that you need to eliminate this. This is something you will have to identify. You will have to understand on the basis of this principle that we have discussed. Okay? Clear on this? All of you clear on this? Now, on to this elimination, there are various adjustments which will come as we move forward. So we'll discuss about those adjustments also. So far, we have only understood the adjustments in relation to P&L. Now, whenever goods are sold from H to S, S may also have some assets and H may also have some liabilities corresponding to this, if the cash payment is not yet done. Yes or no? Because if S is purchasing, S may have liabilities towards it. H may have debtor towards that. Those will also have to be knocked off. Number 3, When S1 has purchased goods from H, S1 may or may not have sold all those goods outside the group. If the goods are sold outside the group, then there is no problem, absolutely. But if the goods have been purchased and those are still lying with S1, say this 2000 of purchases, worth of rupees 100 which has come from H is still outstanding in the inventory of S1. Then if you'll observe, inventory of S1 will have some markup, will have some profit margin, which H would have charged to S1. And ideally, that part of the inventory should also go off. You will be thinking, sell that eliminate inventory also? Yes or no? And how do we eliminate inventory? Correct. Secondly, if we keep inventory, then the profit element on the inventory will increase the profit of the group unnecessarily. Yeah, that will increase the profit element of the group unnecessarily. So that elimination is also required to be done. Yes or no? So similar to this, there are various other elimination adjustments that we'll move on to. But that is all based on the principle of elimination adjustments. For the time being, I am not moving on to inventory or any such elimination adjustment. My idea is to get back to this counting entry in relation to dividend for the time being. Yeah. So what we can do is we can now move on to this accounting of dividend. You can now start referring to this page number 14.70 and let's understand this principle. Because this will also have some linkage to this. As per Ind AS 109, how do we recognize dividend? How do we recognize good dividend? Dividends are recognized in the P&L of the investor. Remember, now the dividend accounting is not done by revenue standard, something which we used to see under Indian GAAP. Now it's driven by Ind AS 109. So if an investor has invested in equity shares of a company, so the dividend which it will get from the company will be recorded in the P&L of the investor. That's the principle. Okay. And when will this dividend be recorded by the investor? Only when the right to receive dividend is established, it is probable that economic benefits associated with dividend will flow to the investor and amount can be measured reliably. So if you look at the second and the third condition, these are in relation to recognition of asset. Means economic benefit should come and the amount should be measurable. Obviously, otherwise, can we record any receivable? Can we record any asset? Not at all. So that means the most important condition is what? To check whether the right to receive dividend has been established or not. If that has been established, then of course it can be recognized as dividend income. Further to this, if you look at the requirements of Ind AS 27, which is not yet covered by us, an entity shall recognize a dividend from a subsidiary in its separate financial statements. We are not talking about consolidated financial statements, separate financial statements, when its right to receive dividend is established. Obviously, whether it is about subsidiary or any other entity, when can the dividend be recognized? Only when right to payment is established. As per the Companies Act, entity's right to receive dividend is established when the dividend is approved in the annual general meeting by the shareholders of the company. So that means, when can the dividend be recognized? When it is approved by the shareholders in the AGM. Therefore, now under Ind AS, do we record proposed dividend, which we used to do earlier? No. Now the proposed dividend is not recorded. When that proposed dividend for the year end is approved by the shareholders, it gets recorded, and that's why it gets recorded in the next year. Yeah. Moving further, an investor should recognize a dividend from its subsidiary, JV, or associate as income in its separate financial statements. Yeah. As per Ind AS 36, declaration of dividend by subsidiary, associate, or joint venture with a few more evidences, coupled with a few more evidences, is an indication of impairment of investment. Now, what does it require? It requires certain factors to be analyzed in relation to the dividend, which is declared by subsidiary, which is declared by associate, which is declared by joint venture, in case those exist. Yeah. Yeah. Whenever it comes to the requirements related to the recognition of dividend. And this is something which we'll understand in more detail when we move on to this illustration number 10. Okay. So what we can do is we can just pick up this illustration number 10 now. I don't think we'll be able to complete this. Okay, so that's why I will not go to the solution at all. What I would suggest is I will explain you this illustration right now, and considering the time constraint, because we'll not be able to go to the solution, please just try to go through the solution on your own and think about this solution with the understanding of elimination and all of these consolidation rules, etc., that we have discussed so far. Okay, yes. So now I'm moving on to this illustration number 10. XYZ purchased 80 shares of ABC. So if you want, you can also note down this chart. This will help you to understand the solution better. XYZ purchased 80% shares of ABC. On 1st April 2000 X1 for rupees 1,40,000. So this is 1st April 2000 X1. Issued capital of ABC on 1st April X1 was 1 lakh. And the balance in P&L was 60,000. Its P&L balance was 60,000. For the year ending 31st March X2, ABC earned a profit of 20,000, and later on it declared and paid a dividend of 30,000. So it earned a profit of 20,000. And it also declared, ABC declared a dividend of 30,000. So dividend is declared over here. 30,000 is the dividend. Assume fair value of NCI is same as fair value on a per share basis of purchased interest. All the net assets are identifiable net assets. There are no non-identifiable assets. Fair value of identifiable assets for the simple point is 1,50,000. So for the subsidiary, fair value of net assets is 1,50,000. Show by an entry how the dividend should be recorded in the books of XYZ Limited. this dividend. How should this be recorded by XYZ? Why? Because XYZ will also get a share of this dividend. Not exactly 80% share XYZ will get. How should that be recorded? Whenever it is received after approval in the AGM. Number one. Okay, so this is first question. I think it's fairly simple. You can do this on your own. What is the amount of NCI on 1st of April X1 using fair value and its amount on 31st March X2? Also pass a journal entry on acquisition date. So we need to compute NCI on this date and NCI on this date. This is again possible, very easy for us to do. Third, this assumption is only for illustration purpose. However, in practical scenario, the fair valuation of NCI will be different than the fair value on the controlling interest. Okay, yeah. Clear on this? Yeah, all of you clear on this? So this is something which I would say you should practice on your own. And in the next session, when we meet, we will also continue our discussion with the same point. All right, yeah. So with this, we can just conclude our discussion over here. And I would like to once again thanks all of you for your time and for your wonderful participation. And please don't forget to note down this homework. Huh? Okay, thanks so much.